All right, good evening, everybody, and happy Monday. Hope everybody had a good weekend. Hope everybody had a good long weekend for those of you who had the pleasure of being off today on this Columbus Day. I want to take a minute to say happy Thanksgiving to all of our Canadian viewers. I know we have a lot of viewers here on the Walks on Wall Street channel that live in Canada, so I just wanted to wish everybody a very, very happy Thanksgiving. So to all of our Canadian viewers, hope you had a blessed day today and a great holiday with you and your family. But today is October 10th, 2022. It is a Monday. Now, the bond market was closed, but the stock market was open. And we pretty much had a pan sell-off across the board. The NASDAQ composite was down about 110 points to 10,542. The S&P 500 was down about 27 points to 3,612, and the Dow Jones Industrial Average followed the three major indices lower, 93 points to 29,202. But one of the things that we're going to talk about on tonight's live stream is an interesting interview that I came across today, and it was on CNBC. And usually, I'll have CNBC on in the background during the day, but very, very seldom will I actually, pay close attention and tune in only if there is a very, very specific people talking. And one of those people is Paul Tudor Jones, Stanley Druckenmiller, and Ray Dalio. If they are speaking, I'll definitely tune in. So Paul Tudor Jones is in New York City this week for, I think, the 10th annual JP Morgan / Robinhood Investor Conference. And he did a really, really good interview with Andrew Ross Sorkin, sort of talking about defining decades, right? So we're going to talk about that interview today. If you guys actually want to watch it and sort of follow along, if you type !PTJ, so Paul Tudor Jones, !PTJ in the chat, you could watch the interview. It's about 4 minutes. Very, very critical for you guys to watch that. I think you can get a lot of value out of it. But before we go into that, let me just say hello to everybody in the chat, and let's head downstairs. I see Otto is here, Paul Greenwell, Vinny Castellano, good to see you. Hey, Mike C is here, Sweet Country Living in Michigan. Christian is here, says hello, Tom in chat. GX72, Steph writes, says hello from England. Today is my birthday. Hey, happy birthday, that's awesome. Happy birthday. I will forewarn you, we may lose signal in the elevator. So if we go out, I'll just have to restart the live stream. So just be cognizant of that. I see War Walker. I see Blues Writer. Good to see a Blues Writer. Trust you well. But yeah, if you guys get a chance, maybe you already caught it, but that interview is really, really good with Paul Tudor Jones, going through each individual decade, defining the 1970s, the 1980s, 1990s, 2000s. And he gives a little bit of a prediction about what he thinks the 2020s are going to look like. And it's very, very similar to what we talk about a lot on the streams. So once we get in the elevator here, hopefully we don't lose signal. Very nice elevators. Hey, Gott says, did you see the Jamie Dimon recession comments? I did. I want to talk about that too. I did see that. Linda says, I want to watch the whole thing. Hold on, let me just get out of the elevator here. We may be getting some buffering. All right, team, we are officially on ground floor level. We are on 34th Street in between 5th Avenue and Madison Avenue. It's not too bad out. Weather's not too bad. Hey, Solo 401 is here. Dan Zhang says, I watch Bloomberg most of the time. I missed the interview. Yeah, so Dan Zhang, check it out. I think you'd like it. I think you're gonna like it. Let me see if I missed anybody. I see sunshine, New York City, sunshine after rain. Welcome, welcome. Gott is here, Steph Wright. Ryan Royal, welcome. GX72, I see Sally says, hey Tom, how was your day? My day was good. Not too busy. I feel like half the people in the city were off, half of them were working. The city was very, very busy, so I think there were a lot of tourists here. Fidel Cashflow is here. Z, welcome. Vinny Castellano, good to see you. And just quickly, one more time, I'll reiterate it. Today is obviously Columbus Day, but it is also Canadian Thanksgiving. So I know we have quite a few viewers on the Walks in Wall Street channel, podcast, whatever you want to call it, who are from Canada. So hope everybody had a fantastic time. So the bond markets were closed today, but the stock market sold off pretty harshly. However, during power hour, so from the hours of 3 p.m. to 4, we did rally a little bit into the close. But I think as of right now, Asia is trading down quite harshly. Wow, look at the view of the Empire State Building we got here. So this is the corner of 34th Street and 5th Avenue, and the Empire State Building is lit up bright red. Now, I wonder why that is. Does anybody know why the Empire State Building is lit up bright red tonight? We're gonna be headed uptown. We haven't ventured uptown in quite some time on the stream. Plains and Palm Trees says, good evening from Toronto. Happy Thanksgiving to you. Angel says, hey everybody, welcome. Good to see you. So tomorrow is actually a pretty interesting and notable day here in New York City as it relates to the investment business or the investment world. We'll talk about it once we cross the street here. We're waiting at these classic New York City 10 to 15 minute red lights. So tomorrow officially kicks off the 10th annual JP Morgan / Robinhood Investors Conference. It is going to run from October 11th to October 12th. And if you want to go in person, this is going to be the first time the conference is in person. Over the last 2 years, obviously, it was virtual because of COVID. So it's really nice that it's finally going to be back in person at the Spring Studios, New York City. Now, you guys are familiar with this conference because I always send you interviews and clips from the conference years ago. Now, if you remember, one of my favorite interviews that took place, I think, in 2017 at the JP Morgan Robinhood conference was an interview between Stanley Druckenmiller and Paul Tudor Jones. And I believe this was either 2017 or 2018. Now, I forget the Nightbot command, but maybe one of the moderators can find it. But tomorrow the conference is going to be going on for its 10th annual year. But I think before we sort of get into that conference, because I'm assuming it's probably going to be recorded and they'll upload the interviews later, maybe at a later date next week or something like that. But one of the things that I would do is go back and watch that interview with Paul Tudor Jones and Stanley Druckenmiller together, because I think you can get a lot of value out of it. Now, what we're going to be talking about tonight is the interview from today. Paul Tudor Jones appeared on CNBC as he was being interviewed by Andrew Ross Sorkin. So if you want to watch that clip from that interview, if you type !PTJ in the chat, the Nightbot will drop the link to that interview. Hey, Buff20 is here. Marcy, what's up? Ecom World says, what's up, Tom? Doing pretty good. How are you? I see Michelle McGraw is here. Hope you're well, Michelle. Let me give you guys another view of the Empire here. Wow, check this out. You know what? It almost looks like this is holiday lights, doesn't it? This almost looks like the Empire State Building color scheme from like Christmas. Polo Dream says, hey Tom, can you tell me, are there any marijuana dispensaries open in New York City yet? I want to say yes, but I really don't know too much about that, to be honest. But I think there are. I think there actually are. Hey, Max says, apparently the building is red, white, and green for Indigenous Peoples Day. Copy that. Yeah, today is Indigenous Peoples Day / Columbus Day, whatever you want to call it. And Canadian Thanksgiving all wrapped in one. Big holidays today. Now, markets were down across the board, and we actually had the NASDAQ composite break below and close pretty solidly below their June lows. Obviously, the bond market was closed, so we couldn't track the bond market, but I think futures just opened up trading, and that 10-year U.S. Treasury yield is off to the races. I think the last time I checked, before I just started to stream, the yield on the U.S. 10-year is trading at about 3.957%. So I wouldn't be surprised by the time stock trading opens tomorrow, we have a 4% 10-year U.S. Treasury yield. Would not be surprised. Hey, Robert, good to see you. This is red, white, and green could also mean Columbus. Sounds good. Good to see you, Robert. Thank you for being here. Yeah, Mike C says 4%, here we come. Very possible. Well, according to bankrate.com, and I'm going to put my hood up because it's actually kind of cold. Was not expecting it to be this cold. Maybe it's just because I was in the office all day in the heat. But it's actually pretty chilly. So according to bankrate.com, the yield on the 30-year fixed rate mortgage is now officially above 7%. So this is the average. So to be exact, the yield on the 30-year fixed rate mortgage, according to bankrate.com, as of today, is trading at about 7.04%. Now, granted, that means many people are getting quoted above that, many people are getting quoted below that. And this all comes back on some key piece of, I would say, economic news that we got out today. So listen to this, everybody. This is going to blow your mind, but not really if you've been watching the stream. I actually want to walk a little bit further down so I can give you guys one more shot of the Empire State Building. It just looks so amazing today. Now check this out. Mortgage demand has officially hit the lowest level since guess when? Since in history. Mortgage demand is now at its lowest level in history. Now, why might that be? Well, I mean, we've been in an environment, I would say really ever since 2012 on upward, of extremely, extremely suppressed rates. So it has allowed individuals to get into properties and acquire real estate because debt was just extremely cheap. Now, think about the price gains in some of these markets across the United States over the last 3 years alone. I mean, some markets have been growing at a 20% CAGR, which is just not sustainable at all. And we've talked about this almost to the point of ad nauseum here. So what does this mean? And it's very, very reminiscent of our live stream last night. Does anybody remember what I said last night? I said a lot of people are scratching their heads and saying, well, mortgage rates are 7%, but how come home prices, we're not really seeing that massive decline in home prices yet? Well, we sort of talked about liquidity, right? And when we think about equities or stocks, when interest rates go up, it's very easy for traders to discount and investors to discount those securities. And you go through a multiple compression or PE compression, and those stocks have been getting crushed. Stocks across the board have been getting crushed, particularly the very, very high beta, high frothy, growth stocks that are found in like the ARK innovation ETFs, non-profitable stocks. But with real estate, it's less liquid. So what happens is homes just start to sit on the market for a little bit longer. And then sellers are like, oh my gosh, my house is sitting on the market for 30, maybe 60 or 90 days. It's not selling. Well, I have to make a price reduction. And sellers are really, really reluctant to make those price reductions because over the past 2 years, they've been watching their neighbors sell their homes at ridiculous valuations. And they're like, wait, I want to sell my house at the same price that my neighbor sold his or hers. Well, the reason why your neighbor was able to sell his or her house at those ridiculous valuations is because interest rates were extremely low. A $600,000 house at a 3% interest rate is much different than a $600,000 house at a 7% rate. I mean, the cost of capital is almost 80%, almost 100% more. So we'll talk about that. But for now, everybody, we are standing right outside the beautiful Stephen Schwarzman building right here, the New York Public Library in Bryant Park. And if you look all the way in the distance here, this is the Bank of America Tower, and right next to it is the Salesforce Tower. Now, interesting news coming out of Bank of America, and get this, Bank of America just now is putting to rest, I think, their last litigation piece going back to the 2008 financial crisis. I think one of their former lenders or underwriters was suing them, and I think Bank of America has agreed to pay, I think, $1.3 billion. And that litigation just ceased, I think, over the weekend. To talk about the ramifications of the 2008 financial crisis, we're just starting to get over the hump. Hey, Freddy780 says Iraq was a bad war to do. Kevin Ramsey says, hello, everybody. Good to see you, Kevin. I see Benny Hinn says, Wall Street is very famous and important. Good to see you. Paul Davis is interesting. I would make sure to only hire incompetent people at my firm. Or competent people. Julmar, good to see you. Carbon Fibers is Tom. My cousin works at the Empire. Awesome. Love to hear that. Hey, Carson is here. Says, hey, Tom. What's up, Carson? Dan Zhang says, Tom, do you think we are going to see a lot of real estate developers pull their building off the market or return them to rentals temporarily? Well, I just think you're going to see in Q1 and Q2, I think that's when you're really going to start to see those price declines. Because that's how it happens. It happens in stages, right? So what happens is the transaction volume dries up in the real estate market, and that's what we've been seeing if we've been paying attention to new home sales and existing home sales. Every single month, existing home sales and new home sales have been in crazy free fall. I mean, talk about extreme deceleration there. So once that buying volume dries up, then what happens is sellers, if they really want to sell their house and they're determined to sell it, they're going to have to make a price cut. And I think it's pretty obvious, not to say it's obvious, but I mean, for a person who is budgeting for a $500,000 home at a 3% interest rate, well, they're probably going to have to change up their budget quite a bit now that rates are double that, sometimes even more. You know, the average 30-year fixed rate mortgage right now, according to bankrate.com, is 7.01%. So Jas Evelyn says, hey and good evening. Hey Jas, good to see you and happy Monday. Andrea says, hey Tom, I'm watching with my nephew Julian. Love that. Hello Julian, thank you for watching. Big Pick says, Tom, OPEC production cut. You're right, Big Pick. I think they cut by about 2 million barrels a day. And so to Big Pick's point, OPEC cut by about 2 million barrels a day. And this comes at a time when the only thing that we had going for positive news of inflation was lower oil prices, lower gas prices, and lower energy prices in general. And then we get hit with this OPEC cut here. And now we see crude rallying over $90 a barrel again, breaking above its 50-day moving average. So I think we're gonna see that headline number over the next couple months tick up. Dan Zhang says, I feel like we are gonna see a lot of realtors quit their jobs. Only the best are gonna survive. Yeah, I mean, I think you're right, but at the end of the day, and correct me if I'm wrong, everybody, I think the vast majority of realtors are not on, I don't think they have any sort of basic salary, right? So if you have a real estate license, I think you just have to take the course. Maybe it's a 72-hour course or something like that. And then you just have to get somebody to sponsor you to sell real estate. I'm not too sure you get a basic salary with that, so could be wrong. Could be wrong. Hey, Amazing Air Show, good to see you, welcome. So let's talk about the Paul Tudor Jones interview a little bit. I think this is gonna be very good and notable to talk about. This is the Price Waterhouse Cooper building, by the way, PwC. Now, Paul Tudor Jones appeared on CNBC, and he was talking to our good friend Andrew Ross Sorkin, which I think is a fantastic journalist, by the way. Let me quickly show you the One Vanderbilt building. And one of the things that Paul Tudor Jones said during the interview is that he thinks it's appropriate for us to go back in time and define the decades. And this is exactly what we do on the live streams. You know, I say, one of the things that Ray Dalio always says, and this has really stuck with me, is that the best investors are the most diligent students of history. So check out, this is what Paul Tudor Jones said. And once again, if you want to listen to that interview by yourself, if you type !PTJ in the chat, I programmed the Nightbot to actually give you guys that interview so you could go and watch it yourself. So Paul Tudor Jones says we can define the 70s as the decade of inflation. Inflation and stagflation. We can define the decade of the 1980s as this very strange boom and bust, these huge big swings in dollar volatility. And what do we think he'd define the 90s as? Let's say the 90s leading up to, 1995. What do you guys think? Yeah, Anand, you're right. Yeah, a lot of innovation in tech and telecom leading up to the 2000 tech and telecom bubble. So the 90s was this innovation, .com, live streaming. And then the O's are probably from around 2001 up to the 2008, 2009 was defined by the mortgage crisis. So the mortgage bubble and the great financial crisis, which led us to the teens. Okay, now this is where this is what we talk about most, is the teens. And here's why. Because a lot of the times on this channel, it's mainly more of a broader based investment focused channel, but sometimes we talk about individual stocks. And a lot of the times we talk about and we cover tech stocks. Now these tech stocks are very, very, high beta, high growth. And over the last, I would say 12 years, a lot of management at these tech firms were really, really hyper focused on growing top line at all costs and really sort of neglecting the bottom line. And many of these companies, some of which are publicly traded, this is Pershing Square, by the way, near Grand Central Station. Many of which are publicly traded, they really don't have any clear path towards profitability. I think that's pretty fair to say. Now, why do we think this was allowed to happen? Well, during the teens, we had unprecedented, I would say, monetary policy experiment and central banking experimentation with artificially low interest rates, liquidity that was awash. Ooh, did you guys see that rat? There was a massive rat that just ran right here. So artificially suppressed rates, and it's not only the Federal Reserve, right? We could think about central banks from all over the world. I mean, the Bank of Japan is still doing quantitative easing, where they're expanding their balance sheet, buying debt, keeping the Fed funds rate suppressed. And this has allowed for a massive economic boom and a stock market rally of the likes we've never seen. I mean, if you zoom out on a monthly chart of the S&P 500 or the NASDAQ or the Dow Jones Industrial Average, it's pretty much like a hockey stick chart going from bottom left to top right with, some minor corrections along the way. But there was a really good tweet, not to get too sidetracked here, but to sort of piggyback off of what Paul Tudor Jones was saying about defining the teens as peak globalization, central banking, experimentation, monetary policy, or this acronym called ZIRP, which is zero interest rate policy. There was a really good tweet on Twitter. I think I retweeted it. If you guys follow me at Walks Wall Street, it was a very notable fund manager. I forget his name, I'm blanking on it, but he's like, markets are very, very dependent on Fed liquidity. So if we are going into an era where Fed liquidity and central bank liquidity is going to be stripped away, well, where do we think markets are going to go? I'll leave you guys to decide. Hey, Mona D is here. This is good evening, Tom, and everybody. Hope you're having a good evening. I am. Hope you're having a good one as well. I see Vonda Howard. I see Abdullah. I see Mohammed. Hey, Mohammed. Happy Monday, everybody. So now we are on, just to give you a quick update of where we are, this is East 41st Street and Lexington Avenue. Dusty Cole, welcome. I see Marcy. Mohammed says, hey, from Egypt, I want to ask, is there anything about Egypt, like a museum or anything about Egypt in New York? Yeah, there is. So if you are from Egypt and you want to come to New York City to see like an Egyptian exhibit or something like that, Mohammed, I would have to recommend the Metropolitan Museum, or the Met, which is actually on the Upper East Side of Manhattan. Now, we're not going to walk there today, but just so you know, if you want to come here to New York, at the Met, there's an amazing, amazing exhibit. And I think there's an actual physical tomb that the Egyptian government gifted the United States. So yeah, there's a ton of ancient Egyptian history all around museums in New York. So you're if you visit here and you want to, see Egyptian history, there's definitely no short of it. But good to see you, Mohammed. JC says, happy Columbus Day, Tom. Thank you so much, JC. I appreciate it. I think there's also a very, very interesting Egyptian collection in the Henry Clay Frick Museum. Now, I think I've brought this up before, I think maybe multiple times, but the Henry Clay Frick Museum is one of my personal favorite museums in the city, alongside the Morgan Library. Now, the actual Henry Clay Frick house is located on the Upper East Side of Manhattan, right on Central Park East, right there on the park. However, it is under construction, and I think it's going to be under construction for some time now. Now, that doesn't mean you can't visit the museum. It's just that means you're going to have to visit like an off-site location, so you're going to be able to see all the exhibits, all the artifacts. That's fine. The only downside is you're not going to be able to see the actual house, which I think is the best part of the museum. Hey, Sam. This is, hey, Tommy boy. Good to see you, Sam. Trust you're well. Thank you for joining us on this chilly night in Manhattan. So I think we're going to walk all the way over to the river because I never take you guys this far. Hey, Sivas is Hey Tom. Hello from India. Welcome. This is now 3rd Avenue. Let's check out the East River on the stream. We never ever do that. Hey, Ed Dunkel says, Tom, the Frick has a bowling alley in the basement? Really? I don't know about that. Ed Dunkel, good to see you though, my friend. Hope you had a good day at work. We're talking about Paul Tudor Jones' interview with CNBC today, sort of defining the different errors with ZERP. Now, I do want to bring up one thing, and not to get too sidetracked, but I think it's important to talk about it, because if anybody remembers, this was about 6 months ago. I wrote an article in the Behind the Street newsletter, which is a free financial newsletter that I write for the group. And one of the things I wrote about was the very, I would say, speculative and high beta growth stocks that Cathie Wood invests in her ARK Innovation ETF. Now, there was some news coming out of Cathie Wood today in ARK when she actually wrote a letter directed and dedicated to the Federal Reserve. Did anybody see that? Did anybody see the article or the letter that Cathie Wood's firm actually wrote, directed it to the Federal Reserve Fed Chair Jerome Powell? But while we're talking about that, check this out. This is a beautiful view of the Chrysler building right here on the corner of East 42nd Street and 3rd Avenue. So in the memo, and you guys, if you just want to go on my Twitter page, you can see it. Or if you just want to Google ARK letter to the Fed. Essentially, Cathie Wood was begging or pleading the Federal Reserve to stop raising interest rates and to cease all forms of quantitative tightening. Now, why might she want the Fed to do that? Now, once again, this isn't going to be a stream bashing Cathie Wood. I think she's an extremely, extremely smart woman. I think she's an absolute pioneer on Wall Street, and I respect her a great deal. I think she has a lot to be proud of in her accomplishments. She's fantastic. However, we always talk about, in the investment business, being willing to admit when you're wrong. And never mistake smart for a bull market. Has anybody ever heard of that? Never mistake intelligence and smarts for a bull market. Now, essentially, she has a very, very high concentration to innovative growth stocks, I would say, innovative tech, where pretty much every single company in the portfolio in her ARK ETF is a very, very high growth, only focuses on top line revenue growth, no profitability, and I would even argue in many instances, and again, not all, but I would argue in many, that many of these holdings do not have a clear path towards profitability in a high interest rate environment. So what did we learn from that? Well, we learned that her particular investing strategy only works in an environment of ZIRP, Z-I-R-P. Now, does anybody want to take a stab at what the acronym ZIRP means? And the first one to get it right, we'll get a steak or something if you're in Manhattan, or I'll buy a coffee. Oh, Carbon Fibers says Tom considers the best neighborhood in Manhattan. I would say the Upper West Side. I'm a big fan of the Upper West Side. So ZIRP stands for Zero Interest Rate Policy. Yeah, photos from around New York, you got it. Wayne McKay, 100%. Cynthia Beals like steak or coffee. We'll have to do both. Hey, I see Paulette says, happy Monday, Tom. Beautiful view. Thank you for showing us Manhattan. Thank you for being here. I appreciate it. Love these American flags here. Big fan of the American flags. 10 out of 10 on the American flags. So yeah, exactly. So ZIRP. So essentially what she is saying, instead of pivoting and saying, look, our investment strategy doesn't work when interest rates are going up. What she's trying to do, and again, allegedly, is she wants to write a letter to the Federal Reserve and say, look, stop with the quantitative tightening, stop raising interest rates so my portfolio can continue to go up. But I think I have really bad news. I don't think the Fed is going to pivot. I think the Fed is going to be so relentlessly steadfast with raising interest rates and quantitative tightening, which means letting bonds run off their balance sheet. And obviously the Federal Reserve holds a lot of mortgage-backed securities in US Treasuries. Now, I don't think they're going to sell mortgage-backed securities right now, but they are selling US Treasuries at their fastest pace in 14 years. In 14 years. Yeah, Mike says, don't think the Fed cares for her opinion. I think so too. And real quick, I want to point out Chrysler building right here and the beautiful One Vanderbilt. You know, the New York City skyline is looking amazing tonight. Not a cloud in the sky. Yeah, so Sunshine After Rain, our moderator, actually just dropped in the chat the letter that Cathie Wood wrote to the Federal Reserve. And so the reason why I bring this up is because we've been talking about on this live stream for probably the last, 20, 30 minutes about Paul Tudor Jones' defining of the decades. Okay, defining of the decades. I'll give you another view looking down 42nd Street. So the 70s was the stagflation environment and high inflation. The 80s was the boom bust and the huge swings in dollar volatility. The 90s was the very, very high innovative tech and first streaming services ever created in the 90s, which led up to the tech and telecom bust. The 2000s, I would say from 2001 to 2008, 2009, was the era or the decade of the mortgage crisis and the great financial crisis. The teens is where we had this monetary policy mush of ZIRP and quantitative easing, QE1, 2, 3, artificially suppressed rates, which led to this massive speculative, almost everything bubble. Which leads us to our last point. Well, what are the 2020s going to be? If we just reviewed everything that happened and we defined those decades very clearly and concisely, well, what do we think the 2020s are going to be defined as? Well, I'll tell you what Paul Tudor Jones said, and then I'll tell you my opinion. Then we could sort of go back and forth in the chat and see what you guys think. But Paul Tudor Jones says he thinks that the 2020s may be a period of fiscal retrenchment. So when we think about fiscal retrenchment, what does that really mean? Well, it means we are going to be in a prolonged period of tighter monetary policy, but not only from the monetary side of the house, but let's talk about the fiscal side of the house. I think whoever's going to be the next president, if that's, Joe Biden again or some other, front runner, they are going to be dealing with unprecedented issues from a fiscal standpoint. I think all of these, Paul Tudor Jones thinks all of these huge fiscal spending packages are going to have to be reined in. Consumers and businesses like me and you are going to have to pay higher taxes to make up for lost time. And term premium on bonds and stocks are going to go to the moon, going to be go stratospheric. And essentially that's higher interest rates for long-term borrowers, right? So in conclusion, what he sort of says, and we did talk about this on the channel, is that what tends to happen in financial markets is it goes from one extreme to the other. And I think really the only way for Americans to have restored faith in the US dollar and in their currency and in their government and even in the Federal Reserve is to sort of go back to this period of no more free lunch, no more ZIRP, no more artificially suppressed rates. Rates are going up. Fiscal responsibility is going to come back. And so what does that mean for stock market returns? We'll talk about it. But what do you guys think? Do you agree with that narrative of the defining of the decades? And do you think that the 2020s, right, so let's say 2022 to 3 to 4 to 5, maybe going up to the end of the decade, do you think that we are going to be transferring into maybe sort of like a Paul Volcker style monetary policy where we jack interest rates and it doesn't matter if the unemployment rate blasts to 10%? What are your thoughts? God says we are going into a great wealth divide. Next stop, Thunderdome. Check out this property here. This looks all abandoned. I'm so surprised. This is prime real estate right here. Somebody should buy this out and make this absolutely beautiful again. They probably will in due time. Hey, Dan Zhang says, Tom, I thought running an ETF means you have to keep buying. You cannot operate it like a hedge fund. Well, you could definitely change your strategy. It doesn't mean that you just need to continue to buy all the way down, and you can manage your risk. Now, one thing I will say about that, Dan, just to sort of piggyback off what you're saying, these ARK ETFs are not cheap. The expense ratios on these ETFs are very, very expensive. And I think Cathie Wood, now don't quote me on this, but maybe somebody could Google it in real time. But I think Cathie Wood raked in like $500 million in management fees, and investors lost, I think, over $1.2 billion. Not a bad trade-off, right? So we are now on the east side of Manhattan, and we never ever come here. So this is the UNICEF building. I didn't even know this was here. Hey, Christy Hansen is here. This is whatever Robert S. says. I second that. Hey, Forever 18 says the perfect storm is about all bad things happen at the same time. What a challenge is the fiscal and monetary policies are hard to slow down the inflation because U.S. heavily rely on import. Yeah, well, I mean, I guess a strong dollar would make imports less expensive, right? And a strong US dollar like we're seeing right now is putting huge amounts of pressure on emerging market countries with dollar denominated debt. Hey, Jewel Marr, thank you so much for the $5 donation. You are very, very kind. Thank you so much. I appreciate it. Yeah, Marcy's like moving on up to the east side. Mike MTL says, Tom, the 20s may be a prolonged weak slump. Well, I definitely agree with Paul Tudor Jones about taxes have to go up because, I mean, we just can't keep running deficits. How else are we going to, pay for, Social Security, Medicare, Medicaid? Dan Zhang says, yeah, ARK has a 0.75% management fee. Yeah, and, Dan, this reminds me of our conversation that we had back in the day when we were sort of dissecting a lot of these ETFs or exchange traded funds that have been coming on the market as of late. Hey, Blues Writer, thank you for the $5 donation. Very, very kind of you. Thank you for supporting the podcast, the stream. Thank you, Blues Writer. All right, what do you think about the beautiful full moon we have right here? And I think we just stumbled right in front of the United Nations. Hey, Diana is here. Says, hey, Tom, hope all is well with you. Thank you so much. Good to see you, Diana. Lou Moran is here. Says, good morning, New York. So to Dan Zhang's point, Cathie Wood management fees is about 75 basis points. Now compare that to, let's say, ticker symbol VOO, right? Now, VOO obviously isn't a very high beta specific ETF. It's an exchange traded fund by Vanguard that tracks just the broader movements of the S&P 500. But I think the management fee or the expense ratio on VOO is 0.03%, I think. And studies show that over the long term, just by, you know, buying the broader market, broader equity indice like the S&P 500, the NASDAQ, the Dow Jones Industrial Average, will tend to beat a lot of those mutual funds and ETFs with high expense ratios, because compound interest works both ways. So think about if you're paying a 1% management fee a year compounded over your entire investment lifetime. That's a lot of money. So if anybody's read the book, and this is a fantastic book, by the way, we're outside the United Nations. It is called Common Sense Investing by Jack Bogle or John Bogle. Unfortunately, he passed away, but I think John Bogle, has done more for the retail investor than anybody throughout history by essentially forcing the industry or forcing Wall Street to significantly reduce their management fees. I mean, does anybody remember way back in the day, let's say if you wanted to buy a mutual fund, back in the day when my parents were my age, if they wanted to buy shares in a mutual fund, well, chances are they were paying something called a front-end load fee. And those load fees could be like 5% on the buy, and then a back-end load fee could also be another 5%. So imagine all of those fees compounded over your entire investing lifetime. That's a lot of money. Now, there was a very, very good article in Investors Business Daily. Dan Zhang says, yes, VOO's management fee is 0.03%, which is even lower than SPY's 0.09%. So this is First Avenue. We never come over here on the stream. Mike C says, I remember paying $30 per trade at Schwab when I first started investing. Yeah, I mean, and that's another thing, the commissions. So think about that. I mean, so Mike C is like, I remember paying $30 in commissions. And we have all of these people, like all the Robinhood people, are complaining that they're getting free trades because of payment for order flow. I'm like, guys, if you didn't have payment for order flow, you wouldn't be getting your free trades. I'm like, trust me, the reason you're losing money in the stock market is not because of payment for order flow. It's because you're buying meme stocks, because you're buying garbage. That's why. It's not because of payment for order flow. Payment for order flow is a godsend for the retail investor. Anyway, I want to give you guys a very, very good article. I think we're going to get trolled by these guys. We'll just brace for it. I want to give you guys a really good article, and this actually happened. Well, the article was posted, I think, maybe this time last year, so I think it's about a year old, but I think it's still very relevant today as we talk about sort of ETFs and management fees and things like that. Now, Investors Business Daily did a study on the specifics of the management structures and the fund structures of a lot of these ETFs. So I'll give you an example of what I'm talking about. If you go to any exchange traded fund that specializes or markets themselves as an ESG fund, so you could buy the, Fidelity ESG ETF, something like that. You could buy the Innovation Robotics ETF. What you'll find almost in every single circumstance is that they have egregious management fees, sometimes over 1%. And if you actually do the due diligence and look within that exchange traded fund, the top 5 stocks are almost all the same in all of these ETFs. Apple, Microsoft, Alphabet, in almost every single one. And then if you look all the way at the bottom, maybe like the 10th or the 11th stock that it owns, you'll see like in an ESG ETF, it'll have like Enphase, Sunrun, something like that. Now, the point of that is a lot of these fund managers wants to keep the beta very, very similar to the S&P. And if they can have a lot of the weighting in that ETF be somewhat similar to the top, 5 or 6 stocks in the S&P 500, maybe it'll move a little bit off base from the S&P 500, They slap a pretty name on it. They put out a nice prospectus with some wind chimes and some windmills and some birds flying around. And then they slap like a 1 or 2% management fee on it. But you're pretty much getting just the same exposure as the S&P with some, you know, junk solar stocks mixed in. Now, I think I programmed the Nightbot to drop that article, but I just forget the Nightbot command. Now, this isn't a sort of statement to say all ETFs are horrible and you should never invest in them. That's not what I'm saying. What I'm reiterating is that you really need to be doing your due diligence here, because studies show, and I'll give you guys another look at the United Nations here. Studies show that millennials are very, very conscious of where they invest their money. They want to make sure their dollars are going to a good cause. So Wall Street has been really, really pushing this whole ESG thing and pushing these, you know, clean energy ETFs and solar ETFs. But 9 times out of 10, you could probably just get better exposure to these industries by just buying the individual stocks outright, as opposed to buying these specific ETFs, because they're very, very highly weighted to the S&P. Hey, Mauricio TJ says hello. Good to see you, Mauricio. Thank you for being here. Check it out. Says, do you think the block of weapon sales to Saudi Arabia will force Saudi Arabia to play ball? I have no idea, dude. To be quite honest with you, I do not know. Now, I did watch, did anybody see that video that was circulating on Twitter as it relates to Saudi Arabia? And they said that, they actually made a good point. And they said that the United States has been very lackadaisical in investing in refining capacity. And that is one of the major reasons why gas prices are so high in the United States. Hey, Alex R is here. Good to see you, Alex. Yeah, Sunshine NYC says super high security here. RJ is here, says hola Tom from Colorado. Hey RJ, happy Monday to you. Happy Columbus Day. Happy Indigenous Peoples Day. And if you're a Canadian, happy Thanksgiving to all of our Canadian viewers. Hey, Clay G says loving this glimpse of the UN. Thank you, Clay. Clay, I'm gonna cross the street so you guys can get an even better view, because very seldom do we come down this way on the live stream. So I want to make sure you guys get a good shot of it. So this is 821 First Avenue. This is the Turkish house. Very cool. But I think once we walk up a little bit, you guys will be able to see the view a little bit better of the UN. Hey, Wendy England says, I am so full sitting here like a beached whale. Happy Thanksgiving to you, my friend, Wendy England. Got yours says, I've been doing well with inverse levered ETFs like SQQQ. Your thoughts? Yeah, so I think SQQQ is the inverse of the, Invesco QQQ, which tracks the NASDAQ 100. So yeah, I mean, if you've been buying that, I mean, you've definitely been doing good. Now, I would like to warn you, those are really only for like trades. I wouldn't hold that for long term, because mathematically speaking, all levered ETFs will go to zero. But if you're just trading around positions and things, I think that's fine. Congratulations on your success, by the way. It's awesome. Slim says, I love the International New York. It is my dream to live there someday. Well, I hope we see you in New York very soon. All right, let's continue to walk uptown. Hey, Taxi Cab is here. Says, I love this part of New York City. What's up, Taxi Cab? Dominic says hello from Maine. Good to see you, Dominic. So everybody, now that we sort of reviewed that Paul Tudor Jones interview that was on CNBC, I do want to tell everybody that there's a lot of big financial names, a lot of big Wall Street names in New York City this week. We'll wait to cross here. So there's a lot of big names on Wall Street in New York City this week for the 10th annual JP Morgan / Robinhood Investors Conference. That'll be taking place tomorrow, October 11th, all the way through October 12th. Now, over the past 2 years, obviously due to COVID, the virus, this particular conference has been virtual. It's been online. So it's awesome to see that this conference is returning to in-person, and it will be located in Spring Studios, New York City. Now, I wrote down a couple of very big notable names that are going to be speaking at this conference. So if anybody is in New York now and you can get a chance, I think you could still get tickets to go to the conference if you make a donation. And the JP Morgan Robinhood Foundation, essentially what they do is all of the proceeds for ticket sales and donations are going towards pulling people out of poverty long term. And I think since the conference started, or since its inception about 10 years ago, they've managed to raise about $48 million going directly towards helping people get out of poverty. So I think that's good. I think it goes to a good cause. So check out some of the big heavy hitters on Wall Street that are going to be at this conference tomorrow. First up is Larry Fink. So Larry Fink is the CEO of BlackRock. They are the largest money manager on Wall Street by assets. Oh, I think this is is this the Trump International UN? I think it may be. Let me see. You know, I never come here, so I'm almost as lost as many of you. Yeah, I think this may be the Trump United Nations here. Hey, Sage says, hey, Tom, I used to walk this area way back in the 1980s. It sure looks different, especially the barriers. I miss the city. Hey, well, it's awesome that we could show you your old stomping grounds. Now, yeah, I did notice that. So all of these barriers here, obviously, probably what happened is after 9/11, I mean, for obvious reasons, there's super maximum security, especially at places like this for obvious reasons. But still a beautiful place. East 47th Street. Now, one of the things you guys will notice in the chat, it's a lot quieter here, isn't it? Since we always stream in Midtown, isn't it a lot quieter here? A lot quieter. So Larry Fink will be speaking at the conference tomorrow, the CEO of BlackRock. Also a very notable hedge fund manager, which we talk about all the time on the live stream. Ken Griffin, the CEO and founder of Citadel Securities. Now, Ken Griffin actually founded Citadel from his Harvard dorm room. And it is one of the largest and most successful hedge funds in the world. Obviously, the most successful hedge fund and the largest is Ray Dalio's Bridgewater Associates. And Ray Dalio has since stepped down. But Ken Griffin will be leading a keynote speech there. Also, Paul Tudor Jones, who we talked about. Paul Singer, founder of Elliott Management. But you know who I'm actually most excited about, everybody? Here's who I'm most excited to hear speak. Now, I'm not going to the event. I really wish I was. If anybody could get me in there, I would love to attend in person. I would make a donation. But Steve Cohen. Steve Cohen is the founder of Point72 Asset Management, and he's the owner of the New York Mets. And I think did the Mets win or lose last night? I think the Mets played last night. But there's going to be a lot of heavy hitters speaking at this conference. And I would assume at the conclusion of the conference, they're going to be uploading a lot of those interviews to YouTube, in which case we'll be analyzing them and talking about them right here on the live stream. But if you're in the city, I would definitely recommend going in person. Wow, check that shot out of the beautiful Chrysler building. Amazing. Hey, Yes Forever 18 says, hey Tom, I am rarely go to Manhattan in the past 4 years. I almost forgot how Manhattan looks because I went to downtown Brooklyn, Williamsburg, Park Slope, and Long Island City. Copy that. Good to see you. Yes, forever. 18. Mike C says the Mets are out. Ooh. Yeah, I'm not a big baseball fan, but I think if I had to root for a specific team, it would probably be the Yankees. Hey, ALH says I used to live at 10 Michelle Place on 49th and Beekman. Very close to your location. Yeah, this is a really nice area. This is 2nd Avenue now and East 47th Street. But I'm not gonna lie, I think I do still like the Upper West Side a little bit better. Brian says, hey Tom, what's the name of the conference that you just mentioned? So it is the 10th annual JP Morgan / Robinhood Investing Conference. Now, Brian, I actually think we discussed before on the live stream a particular interview with Paul Tudor Jones and Stanley Druckenmiller that came out of the conference in 2017. So if you just Google JP Morgan Robinhood Conference, Paul Tudor Jones, Stanley Druckenmiller, you'll be able to find it. Wow, that's a really nice shot looking uptown. Very cool. But for those of you who are just joining, if you type !PTJ in the chat, the Nightbot will drop the link to the Paul Tudor Jones interview that happened today with Andrew Ross Sorkin, in which case he defined all of the decades, right? And he gave a prediction as what will be the most defining, I guess, financial term or topic of the 2020s. So he talked about how the 1970s was the decade defined by inflation, right? The 1980s was defined by, the huge swings in dollar volatility. The 90s, you could classify it as the early tech and telecom innovation, which led to the bust of the dot-com bubble. And the 2000s, leading up to the great financial crisis, subprime mortgages, the mortgage bubble. But the teens is really what we always focus on this live stream when we talk about ZIRP, or zero interest rate policies, and artificially suppressed interest rates by the Federal Reserve. And oftentimes we'll talk about, what I like to call the creation of a two-tier society. And I think the Federal Reserve and easy money, artificially suppressed rates has done more to exacerbate the wealth divide in this country than anything else. Because when you have artificially suppressed rates, what that does is it encourages people to take on more debt, to debt acquisition, and it literally forces people to search for yield in the marketplace, right? I mean, if you have, before the Federal Reserve started raising interest rates, we've just gone through a decade where the vast majority of the debt in the world was negative yielding. So if the vast majority of bonds are negative yielding, who is gonna buy a bond, right? So it forces people to take risk. And how do they take risk? They buy stocks. They buy growth stocks. And they not only buy them, they buy them on margin. They play with derivatives and options. And this creates a period of irrational exuberance and speculation. Now, ever since 2011, 2013, the equity markets have been on a one-way ticket higher. And that's obviously due to increased global liquidity from central banks around the world, most notably the Federal Reserve, ECB, Bank of England, and the like. So really the only people who benefited that time were people who owned the vast majority of assets. And if you look at the data, the people who own those assets are the top 10% of Americans, when everybody else tends to live paycheck to paycheck. So it's created that massive wealth divide. So you've seen asset prices get inflated over the past decade, but wages have been relatively stagnant. So it's made it very, very hard for class mobility. And one of the most important things about the United States, in my opinion, is the availability and the opportunity for class mobility. You know, to move up from the lower class to the middle class and sequentially to the upper class. But now Paul Tudor Jones thinks that we are going to completely do a 180, a complete about face, and go through a period of retrenchment where we have higher interest rates for a prolonged period of time. We have more responsible fiscal policy, so no more huge spending packages, no more Trump bucks, no more Biden bucks. And this could potentially lead to a few years of very, very poor returns for the equity market. But there may be a few areas of the market that could generate significant alpha. And we'll talk about that. We'll talk about what those asset classes may be. Sabrina Fair says upward mobility will become much harder with zero growth. Yeah, I mean, potentially. I think you're right. Yes, Forever 18 says we are actually under a currency war today, and the US dollar is the strongest, making many money existing in the market. Or do you mean making many, it's making it very, very difficult for emerging market countries. Yeah, you're right. You're 100% right. Hey, Linda Silva is here. Good to see you. Thank you for joining. So we are now making our way to Park Avenue, but look at this. This is a really, really nice view of the Chrysler Building. But if you guys are enjoying this live stream tonight, feel free to leave a like on the video and subscribe to the channel. If you're new, hit the subscribe button. We do these walks and financial talks about 5 days a week between New York City and Miami, and we'd love to have you along for the ride. Hey, Bagels and Walks is here. Happy Monday. Bob Shee says, Tom, how much do these personal cars pay per night on average per parking? So I think to park in a parking garage, maybe it's $100, maybe a little bit more. Now, one of my first jobs as a teenager, I was actually working in a parking garage, and the particular parking garage on 83rd Street between Amsterdam and Columbus, the one that I worked at, we would charge people over $400 a month to park a very, very small sedan. Now, if you wanted to talk about parking like an SUV, you were looking at like $750. So just to put that in perspective, crazy. Hey, NMB 045 says, Tom, I think the 2020s will be defined by the localization and de-globalization of supply chains. Yeah, NMB 045. That is a fantastic comment. That is an absolutely fantastic comment. And I think you may be right. I think you may be right because, you know, to your point, I think we can add one more thing to our description of the teens, and that is extreme globalization. And one of the things that we're seeing now, and I think really COVID sort of exposed all of this, is that companies really want to have more control over their supply chains. And we're starting to see this with companies, specifically semiconductors, pledging to build multi-billion-dollar facilities, manufacturing facilities in the United States, bringing back the manufacturing capacity to the United States. Now, granted, I think the manufacturing that's coming back to the US is going to look a lot different than the manufacturing that was here in the 70s and 80s. I think much of the capacity is going to be automated with robotics and things like that, but I think you're right. NMB 045. So we are standing outside of Jamie Dimon's bank, JP Morgan Chase, and we are overlooking the beautiful 432 Park Avenue. Now, this is a stunning building on Billionaires Row near 57th Street in Manhattan. And this is 277 Park Avenue. Now, this is one of the newer JP Morgan Chase buildings. However, if we look all the way across the street, this is going to be the brand new office tower of JP Morgan Chase that I think is going to open in a couple of years here. And this is once again Park Avenue, and here you have a great view of One Vanderbilt. Hey, Austin City Limits, good to see you. Thank you for being here. Big pick. Hey, Western Mass Dave says, wait, clean streets in New York City, question mark? Yeah, I think it may have been garbage day on Sunday. Yeah, the streets do look pretty clean here on Park Avenue. Hey, Daniel says hi, good to see you, Daniel. Pamela S says, Tom, BlackRock might be going bankrupt. Serves them right for buying up housing. I don't know about that. I'd give a little bit of pushback on that, but I respect your opinion. But I could almost say with 100% certainty that they will not be going bankrupt. But yeah, I don't think BlackRock is going to be going bankrupt. Derek David Jr. says, hey, how was your day? Day was pretty good. How about yours? You know, I noticed a lot of people in the city, and I think that's because the vast majority of people had off. Now, bond markets were closed, so we couldn't really keep tabs on a lot of that action in the bond market with that 10-year US Treasury yield. But I think, and maybe some of you guys, if you go to cnbc.com/bonds, once again, cnbc.com/bonds, check out where that 10-year US Treasury yield is trading right now. I wouldn't be surprised if we open at 4%. You know, right before I started this live stream, I think the yield on that 10-year Treasury was 3.92%. And I think the 2-year is maybe 4.2%. Obviously, we have inversions all the way across the curve. But this is one of my favorite statues here. This is an artist by the name of Cause. Awesome. Hey, James Tiger is here. This is 3.978%. Yeah, so we're probably going to break over 4% tomorrow. Good to see you, James. Hey, Daniel G is here from Buenos Aires, Argentina. Good to see all of our Argentinian viewers. Thanks for being here. Yeah, this almost looks like Elmo. So my old building, 1166 Avenue of the Americas, we had this guy in there, but we had a black one. So ours was black, same size. Hey, Julia M says, hola, fam and Tom. Sorry I'm late to the party. Julia, good to see you. Trust your day was well. We're walking up Park Avenue, and I'm actually going to take you guys to my favorite building in all of New York City. It's called the Seagram Building, and is my absolute favorite by far in New York. So the Seagram Building is right here, and I think Center Bridge Partners may be located in that building. But we are walking northbound on Park Avenue, passing East 50th Street. So I did want to take a quick poll in the chat. Every so often I like to do this, and especially I want to do this now because this week we are getting the CPI numbers out. So the Consumer Price Index will be released this week, along with the minutes from the last FOMC meeting. Now, here's something that's really strange. Now, headline CPI is expected to decrease, come down a little bit. And obviously, that's due to the declines in very volatile energy prices. This is Raymond James. But core CPI, which is the more important number that we need to be paying attention to, is actually set to increase. And the reason why that's an issue is because we just started. Just let me cross the street. We just started this environment of 75 basis point rate hikes, 75 basis point rate hikes, 75 basis point rate hikes. And in order for the Federal Reserve to potentially pivot, which they're not going to, they want to see a couple things happen. Number one, they want to see the unemployment rate actually go up. We actually got the polar opposite. We saw the unemployment rate go from 3.7% back down to 3.5% when we got the non-farm payrolls out. Non-farm payrolls came in at 263,000. Consensus was for 250,000. We also saw that wages was up 5% per annum year over year. So if we get a hotter than expected core CPI number, I think we're probably going to get, with 100% certainty, another 75 basis point rate hike at the November 1st, November 2nd Fed meeting. So really quick, we are standing right across from my favorite building in the entire city, the Seagram building. Look at how fantastic it is. Look at how marvelous this thing is. Absolutely beautiful. So as of right now, as of recording the video, the current Fed funds target rate is 3% to 3.25%. Now, if we get another 75 basis point rate hike, that's going to take the Fed funds rate at the target to about 4%, maybe 4.25%. Now, many economists on Wall Street are projecting about a 4.5% Fed funds rate at the conclusion of the year. And I think we're going to get there. Now, I want to take a poll because we've just recently seen a renewed rally in crude oil, which I think is going to trickle down over into increased gas prices. So in your neck of the woods, wherever you are in the world, in the United States, if you want to participate, please type in the chat where you're from and what you last paid for a gallon of gas. I'm very interested in that. Here's another shot of 432 Park Avenue. Absolutely beautiful here. So type in the chat where you're from, what city or state, and what did you last pay for a gallon of gas? I think it's going to be interesting what we see the responses here. So Clay, Jesus, Tom, I paid $3.19. That's not bad. UCAN says Ohio $3.88, Brian $3.75. Got yours is $6.99 a gallon in California. Apron says NYC baby $3.70. Okay. Brett Ritz is Southern California desert today at $5.69. Jeez. Hey, buy the books is San Diego. So Pamela S is $3.11. So we're pretty much all over the board. Hey, Diamond Dave says, good evening, Tom, from Mesa, Arizona. I paid $4.99. Marcy says $3.29. Michelle McGraw says $3.79 in Ohio. Mark says $3 in Iowa. Wow. So we're getting readings all over the board here. Paulette says Miami, $3.79 for premium deep value. Alex says $3.79 in Miami. So far, California is blowing everybody out of the water with the high gas prices. Virginia's not too bad. Hey, Rich says $4.39 for premium in Milwaukee. That's actually pretty expensive too, Rich. Good to see you, man. Hopefully you had a good Columbus Day. Got yours to 60 cents of Cali gases for road taxes alone. That's insane. Now, See, that's my whole thing. I don't understand how the average working class or lower class person does it in California. Because at the end of the day, I think we need to take something into consideration. So I'll quickly show you guys the plaque here at the Seagram building. This is by far my favorite building in the entire New York City. Now, hear me out. And I think this is important because we're getting the CPI data out this week. If you live in New York City, I understand it's expensive. I understand the taxes, the city tax, the state tax. It's a very expensive place to live. But here's the major thing that we have going for us here in New York as it relates to somebody that may be, middle class or lower class, working class, as opposed to somebody in California that's the same type of class status. Now, we have extreme access to public transportation that is very cheap. You don't have that in California. Now, correct me if I'm wrong, I'm talking about on a broader base scale. So think about if you have to fill up your gas tank in California and drive to work every day. Maybe you're a restaurant worker, maybe you're a home health aide or something like that. That is like a vice grip on your savings. And that is very, very concerning to me. And I think the Fed is taking all of that into consideration. At least in New York City, maybe you forego driving into the city and you take the train, to save a little bit of money on gas. But am I making sense? What do you guys think about that? Hey, Daryl says, happy Columbus Day, Tom. Thank you, Daryl. Appreciate it. The one and only British Gray from Tampa, Florida is here. Good to see you. So Big Pick says, Tom, buy bonds before the CPI data comes out. So Big Pick, what is your thesis on that? Because the bond market wasn't open today, but I was looking at the TLT, and the TLT is the exchange traded fund that tracks the bond market. And we got pounded today. We broke a new all-time 52-week low in TLT. So bonds have been getting pounded. And I think bonds may continue to sell off. Hey, Disney cast member, good to see you. Disney cast member was sending me some amazing photos of the leaves changing colors in upstate New York. Wow, look at that. Look at the MetLife building. And right above the Grand Central Terminal. Mimi says, I heard California is giving out gas rebates. Well, I think they may be giving out some sort of like a stimulus check. And I don't want to get too political, but I think you guys know what I think about that. All right, maybe we'll go this way. We'll go to 432 Park Avenue another night. Yeah, Marcy's like it's a Christmas preview. It looks great. Now, there is a saying that a lot of bond traders like to make, and it's buy bonds, wear diamonds. Has anybody ever heard of that? So speaking of Larry Fink will be speaking at the JP Morgan Robinhood conference tomorrow. And BlackRock is right here alongside with Evercore. I really wish I could be in person for that. I really like to see Larry Fink speak. Maybe next year. But I think that the strategy of buy bonds, wear diamonds hasn't really worked out too well this time around, as we've seen rates go on a meteoric rise. Speaking of another major financial firm, we are coming up on Jefferies. And Jefferies has a very, very unique office here in New York City. Look at how cool Jefferies' office tower is. Now, I'll tell you the reason why I like it so much. It gets very, very skinny at the top. Andreas, hey, good to see you, man. Andrew says, Tom, so $4.24 US dollars a gallon for Canadian fuel. And this is where you could buy some of your freshly minted deal sleds for all of our investment bankers in the chat. Maybe EBITDA's watching tonight. Pick up a new pair of deal sleds. So this is Madison Avenue and 53rd Street, outside of the Jeffries building. Hey, Marie Rose, good to see you. Welcome. Vance says, Tom, are you going to the ferry tonight? Not tonight. We're a little bit too far away from that. Hey, Billy says, need a career change. Real estate, just not making ends meet nowadays. Yeah, so Billy, we sort of talked about that as well tonight. Now, we got a piece of economic data that came out, and I think for all the real estate salespeople in the chat, maybe for all of our mortgage bankers, could relate to this and maybe provide some clarity and further context. I'll give you one more shot of 520 Madison. This is Jeffries. Now, mortgage demand fell to its lowest level in history, an all-time low. Now, if you've been watching the streams, this is no surprise to you, because almost every single night on the streams, one of the first things that I do is a recap of where bond yield's at and what is the average yield on that 30-year mortgage, fixed rate mortgage. And according to bankrate.com, as of today's close, the average 30-year fixed rate mortgage is 7.02%. So all the people that were buying, $500,000 and $600,000 homes last year at 3% rates, well, those same people that budgeted for the same valuation home, you can only afford about half that, assuming you're going to make a 20% down payment and get a 30-year fixed rate loan. So to Billy's point, transaction volume has fallen off of a cliff. And I sort of explained this before, but a lot of people have been wondering, well, how come housing prices just aren't dropping yet? We're seeing stock market valuations get cratered. Individual stocks in some instances are down 80%, 90%. Just look at Kathy Wood's ARK Innovation ETF. I wrote an article about this about 6 months ago and said, look, once rates go up, that thing is going to get pounded into smithereens. Look where we are today. But real estate is less liquid, right? Just think back to your Finance 101 class, right? Just look at a balance sheet. The balance sheet is an order of liquidity. So the first thing you have on there is your cash and equivalents, your marketable securities. And then the further down you go on the balance sheet, you get to the property, plant, and equipment. So for real estate, it takes a little bit of time, maybe a couple quarters, for interest rates to start really impacting price. Because the first thing you start to see is the economic data we've been covering here on the stream. This is St. Thomas Church, by the way. Absolutely a marvel of the city, absolutely beautiful. But what you'll start to see is existing home sales decelerate and then fall off a cliff. That's exactly what we've been seeing. Then you'll see new home sales decelerate and then fall off a cliff. That's exactly what we've been seeing. And then phase two is when valuations and prices start to come down. Because if I list my home for sale, and last year, I'm like, hey, my neighbor Fred, he sold his house. It's a 3-bedroom, 2-bath. I have the same house, almost the exact same plot of land. He sold it for $600. Well, I could sell it for $600 too. Well, not so fast. When Fred sold his house, buyers in the marketplace were dealing with a 3% interest rate on a 30-year fixed. Well, rates have made over 120% move this year. The average 30-year fixed rate mortgage is 7%, so their buying power is pretty much cut in half. So your property is going to be sitting on the market for a lot longer, and subsequently, If your property sits on the market for maybe 30 days or 60 days, that's not a good look at all. So you're gonna have to cut your price in order to match that buyer demand. And I think that's what you're gonna start to see. So my prediction is that in Q1 and Q2 of next year, that's when you're really gonna start to see the prices start to come down. So let's say if you're a first-time home buyer or you're an investor, I think you're gonna be able to negotiate from a really, really good position of power here. And number two, you're gonna get cheaper prices. I think it's almost guaranteed. Now, maybe in some specific markets you won't, but I think home prices have to come down because rates are just so high and buyers are priced out of the market. I think Morgan Stanley just put out yesterday, or I think it was this morning, that home affordability is in an all-time record low today. Yeah, Disney cast members has plenty of homes in Las Vegas. So Disney makes a good point because that's how it usually works, right? The markets where you have the most price appreciation during the bull market is usually the markets that correct the most during the bear. Hey, Changer says hello from Australia. Welcome to all of our Australian viewers. Good to see you.
Whoa, real quick. Yeah. I talk too much. What?
Mike C, good to see you. Paper planes are planes and palm trees, as people don't need to sell real estate at a discount when the rental market is on fire. Many sellers pivot to rentals instead. That's a very good point. That's a fantastic point. And, you know, to your point, to play devil's advocate here, I always like to give two sides of the story. To your point, well, we haven't really been seeing a huge uptick in inventory. Now, maybe a little bit, but not a lot. And so here's sort of the comparison between the 2008 financial crisis to now. I don't think we're gonna start to see massive amounts of inventory hit the market. So here's what you may see. You may see some articles that say, oh, we have 100% increase in inventory on the market year over year, and then they're gonna call for Armageddon. But last year there was literally like no inventory. So if there's two houses on the market and you get 100% increase in inventory, it's still nothing. Now, the reason during the 2008 financial crisis why we had so much inventory is because the vast majority of people who owned homes were purchasing them with ARMs or adjustable rate mortgages. They had very, very low credit quality. So the bank's underwriting standards have improved substantially. So it's a lot safer environment now. So really the only time that I think that we should get a massive wave of inventory on the market is if we have sort of a situation where we have people defaulting on their debt at record numbers like we saw in 2008. I just don't see that happening. To your point, you may be technically underwater on your property, but you could always rent it out. That's a good point. Now, my concern, and I think I've voiced this concern before, but many of you said, I think many of you disagree with me, which is fine. So I think I'd like to present this thesis again, and then maybe some of you can provide clarity and context. So how many people do you think right now, so this is 57th Street and 5th, by the way, just so you guys are up to date on where we are. We are now officially on Billionaires Row in New York City. So how many people do you think during the pandemic moved 200, 300, however many miles away from the office because they thought they would never be called back into the office in a million years? They bought a piece of property and then their boss says, whoa, 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 COVID's over, you're coming back to the office. How many people do you think are actually impacted by that situation to where they would say, oh my gosh, my boss is calling me back to the office. I bought a house, let's say way upstate New York. Now I have to commute to the city every day. I can't make the 200-mile drive. I have to sell my house. Now, do you think that is a very, very anecdotal situation where it's only maybe like a handful of people? Or do you think that could potentially affect more people than we think? What do you guys think about that? So by the books, there's quite a few. Somebody says, surely nobody is that dumb. I mean, I'm not here to call names, but I mean, you never know. Hey, Willie is here. Good to see you. R2D2 says, I think a bunch of people did that. The LT Prod says, depends on where. Diamond Dave says, maybe about $250,000. Yeah, well, I think in those instances, I mean, if you were lucky enough to work remote, chances are you probably had a pretty good income. And if anything, you could probably rent out your home and then rent a place in the city or something like that. JR says, Tom, more than we think. Maybe. So this is the very famous Plaza Hotel. I'll give you guys a closer look at the plaza. Hey Robert, what's up? Mike C says a lot of people move to Sacramento but still work in San Francisco. So I heard that too. You know what I've been hearing? So for all of our California viewers in the chat, some of my friends who have kids that lived in San Francisco, they've now migrated to San Diego, California. Supposedly it's cheaper and it's safer, maybe a little bit cleaner. Is anybody seeing that? A big influx of people from San Francisco moving to San Diego, especially if you have kids or something like that. One of my buddies who has a couple kids, he's like, I had to get out of San Francisco. All right, so this is the main entrance of the Plaza Hotel. Look at how beautiful it is. I think this is one of the most iconic hotels in all New York City. Wow, so Dan Zhang is providing some real-time action in the bond market. This is Tom, the US 10-year is testing 399 resistance level. I feel like it's gonna break the level during the European session. Yeah, I mean, I wouldn't be surprised if we see a 4% US 10-year treasury tomorrow. I mean, at this rate, it seems like that 30-year fixed is gonna go to 8% by the end of the year. You never know. We could have a pretty big blow-off in the debt market. Look what happened. Did anybody see the additional news coming out of the Bank of England? The Bank of England has said that they are going to provide unlimited support, which essentially is quantitative easing. Hey, NMB 045 says, Tom, I've been to San Diego as a Canadian. Better city than San Francisco, although not perfect like most places. So you would say you like San Diego better, NMB 045? Again, this is the 432 Park Avenue building. Right on 59th Street and Central Park South. Hey, Mimi says, yes, Tom, I am renting out my townhouse in San Diego, and people from Northern California are moving to San Diego, also Sacramento or other suburban cities. Now, this makes me want to visit San Diego. I think I got to check it out. Now, I still think, and this is sort of what we saw here in New York too, a lot of people who moved into, geez, what's going on over here? A lot of people that moved into New York City during the pandemic, if you look at the data, they actually were younger people. Younger individuals, because they were like, hey, this is my chance. Wow, check that out. That thing is insane. Man, what is that, a G-Wagon? That thing is crazy. No ESG here. So if you look at the data, a lot of people that were very young moved into the city during the pandemic because they thought, this is my chance to get cheap rent. I'm young, I'm gonna go for it. But the people with kids and maybe an established family, they actually chose to leave. And I think you're gonna see that trend continue. And as the cities, now I think New York City is a very, very safe city. Extremely, extremely safe on a relative basis. But we do have our problems, and crime has been getting out of control. And we actually just saw, did anybody see the CEO of Rite Aid, what she said on the earnings call? I couldn't believe it. I was on the earnings call of Rite Aid. Do you know what she said? I'll tell you what she said. Now, I'm gonna say it, I don't know, if you wanna know exactly what she said verbatim, if you follow me on Twitter at Walks Wall Street, I tweeted what she said and you could listen to it, but she said that we had an unexpected loss this quarter due to shoplifting, particularly in urban New York, resulting in multiple store closures. And I think the loss was over $5 million just in New York City in that particular, for those drugstores, Rite Aid. Anyway, so the point I'm trying to make is, I think as maybe larger cities just see a uptick in crime. Now, I still think it's very safe, but the point I'm trying to make is I think you're going to see families move out to the suburbs and more ambitious, entrepreneurial, younger people, still pile into the cities because they can handle it. You really don't want your kids being around that stuff, but if you're single or something like that, or maybe newly married, maybe it wouldn't affect you at all. Got yours has come on, I don't buy that. Hey, I'm just the messenger. I was on, if you look at Rite Aid's conference call, that's what she said. They had to take about a $5 million write-down due to shoplifting in urban New York. So if you go to my Twitter at Walks Wall Street, I tweeted it out. If you want to know exactly what she said, or if you want to listen to what she said, if you go to riteaid.com/investor relations, you could listen to the earnings call yourself for free. All right, guys. So I'll give you guys the option. We are here on beautiful Central Park South. Look at all the horses here. Very peaceful night. It's about 55 degrees. We are at the very beginning of Central Park. Now, should we walk down 6th Avenue or should we continue walking to Columbus Circle? I'll give you guys the choice. Oh, Gott says, I believe you, but I just don't believe the CEO. Well, I could chime. I don't really want to light the stream off in an argument. Let's not argue about this, but I've been in drugstores many times in New York City. People just walk out with hundreds of dollars worth of stuff. 6th Ave? Okay, I'm seeing a lot of 6th Avenue. All right, we'll go 6th Avenue. But first, look at this shot, everybody. This is a really good shot. Look at the beautiful full moon here over the Upper East Side of Manhattan. I mean, that's just priceless. Man, that is an absolutely beautiful shot. The moon over the East Side of Manhattan. That's amazing. This is my old building, by the way. To my point about how when COVID hit, a lot of younger people moved into the city because we had a flash crash in real estate. This was my building right here. But then the rent doubled again. Hey, Queen of Swords is here. Good to see you, Queen of Swords. Happy Monday. So for those of you who are just joining, I'll give you the Nightbot command one more time. So if you type !PTJ in the chat, The Nightbot will drop the link to the Paul Tudor Jones interview. We were talking about how Paul Tudor Jones was characterizing the specific decades and how Paul Tudor Jones believes that in the 2020s we are going into a new era where we completely do a 180 about face as it relates to monetary and fiscal policy. And we are going to be living in an environment where interest rates are higher and fiscal policy is more responsible. So if you're just joining, if you type !PTJ in the chat, it's a very brief interview. Listen to it. 5 minutes. You're going to get a lot of value out of it. You got to stay on top of this stuff because this is going to impact your portfolio, especially if you have high exposure to equities. Hey, I see Roy is here from San Francisco, California. Roy, happy Monday, man. Thank you for joining the stream tonight. This is 57th Street Station. This will take you into the underworld. We won't go to the subway tonight, but maybe one of these days I'll take you guys down there. Hey, Iris Luce, good evening, Tom. Good evening, everybody. Thank you, Iris. So we are now 57th Street, Billionaires Row. Hey, what's next? Good to see you. You know, since we're on Billionaires Row, I'll just take you guys across the street. And I want to show you guys each individual building on Billionaires Row. I know I've showed you before, but I appreciate the architecture. And I think these buildings look extremely unique, so I'd just like to take a moment to point them out, if you don't mind. Speaking of Dwayne Reed, so guys, this is actually a good piece of market research here. Do you remember I said the only reason why I don't go to Dwayne Reed is because the lines are so long because there's no self-checkout? Look at how long the lines are. The lines are snaking all the way around the store all the time. I think Dwayne Reed and Rite Aid would improve their sales in a minute if they just installed self-checkout. CVS has it, every other drugstore has it. If I was on the board of directors at Rite Aid or Walgreens, I would say you got to do self-checkout. All right, so this is the Steinway building here. This is the newest addition to Billionaires Row right here, 111 West 57th Street. And then as we maneuver the camera around, you will see the beautiful 157 building. Now, talking about very notable money managers, Bill Ackman, who is the founder of Pershing Square. I believe he has a unit in 157 as well as Michael Dell. Oh, this is the Directors Guild Theater. I always forget this is here. So this is the Directors Guild Theater. This is actually a pretty good view. If you look all the way in the distance, this is the Essex House. So that is the original Marriott Essex House. It's a 5-star hotel, and it's not like a modern hotel. So if you're into the very old classic New York style hotels, that is definitely the hotel for you. I've stayed there before. It is absolutely beautiful. Hey, Action Kids, CVS is much better with self-checkout. Many products are locked behind glass too to prevent theft. Yeah, so Action Kid, I want to wish you a very happy Thanksgiving. I know that you're in Canada. Hopefully you had a good Thanksgiving Day. But yeah, so Action Kid, one of the things we were talking about is that Rite Aid, on Rite Aid's earnings conference call, the CEO came out and actually said that shoplifting made a material impact on bottom line, particularly in New York City.
So entertaining.
And I think I have to agree with you in your statements about self-checkout, because I actually personally just won't even go into a Rite Aid or a Walgreens because they don't have self-checkout. CVS is so seamless. It's so simple and easy. I can just go in, get what I need, and get out. So if anybody on the board of directors at Walgreens or Rite Aid is watching this, implement self-checkout. It's going to be a better customer experience. So this building right here is the absolutely beautiful Central Park Tower. Now, the interesting thing about Central Park Tower is that the top 3 floors of the building is selling for a whopping $250 million, so $250 million. Now, the gentleman actually that is up to the task of selling that unit goes by the name of Ryan Serhant, the CEO and founder of real estate broker-dealer Serhant. And he is regarded as one of the most successful real estate agents in not only the country, but I would even probably argue the world in terms of real estate transaction. We actually walked past his office not too long ago. This building is 220 Central Park South. Now, the interesting thing about 220 Central Park South, one of the topics on tonight's live stream was the 10th annual JP Morgan and Robinhood. What was that? 10th annual JP Morgan and Robinhood investing conference, which will be taking place tomorrow. And one of the famous keynote speakers will be Ken Griffin, the CEO and founder of Citadel Securities, one of the most notable and iconic quantitative hedge funds and market makers on Wall Street. He owns a unit in here, but he is also moving his entire firm, well, some of it, from Chicago, Illinois, down to Miami, Florida. So if any of you are fond of our Miami live streams, we've actually streamed multiple times past the new Citadel Securities plot of land where the office will be. But for my personal favorite, everybody, this is 157. Now, this is the building that was developed by the Extel Group, which kicked off this entire trend here in New York City on Billionaires Row. Now, on one side, you'll see the Park Hyatt, which is actually a hotel. It's a 5-star hotel, has amazing amenities, restaurants, swimming pools, gyms. It's fantastic. But on the left side, you actually have the residences, which share all of the amenities of the hotel in one. And this is my personal favorite here on Billionaires Row. All right, what do you guys think? What did you guys think of the Billionaires Row tour? I think I did all right. Teresa Diaz, thank you so much for the $2 donation. Thank you so much. It says 22,100 subscribers. Congratulations. Well, thank you all for joining the streams. I have a very, very good time doing these live streams for you all. And I am very, very blessed to have you all here. So thank you for joining. I'm gonna cross the street and then I'll head back over to 6th Avenue. I just wanna show you guys the Carnegie Hall. Very notable Carnegie Hall. Yeah, so PL 830 says, how do you feel about insurance companies bailing out Florida due to the cost of the hurricanes? Insurance companies bailing out Florida. I don't think they'll bail out Florida. I think it's gonna be a big mess. And we've talked about why the insurance is such a nightmare here in Florida. And it's mainly due to a lot of roofing scams. And that is a huge issue. So you make a really good point. Now, I'm not sure, maybe a lot of you aren't familiar with Florida, but we have a very large insurance company called Citizens, which is essentially like a government subsidized insurance company. And unfortunately, that's where most of the policies are written, because a lot of the private insurance companies have decided to leave the state just because you can't make any money, right? Now, many people say that it's due to increased natural disasters such as hurricanes due to climate change and things like that. And that does play a part, that does. But it's actually the vast majority of the reason is there's been a huge widespread roofing schemes and tax scandals and insurance scams that have been going on in Florida, which has bankrupted some companies. So I'm very concerned about it, to your point. But if you guys are enjoying the live stream so far tonight, feel free to leave a like on the video and hit the subscribe button if you're new. We do these streams about 5 days a week between New York City and Miami, and we'd love to have you along with us each night. So we'll go down one more block and then we'll walk over to 6th Avenue. This is a nice Tesla here. Hey, Christian Wilson, good to see you. Gail Arnold, thank you for being here, Gail. So do you guys see where the Barclays sign is here? That is the Barclays Investment Bank. And that actually used to be the headquarters of Lehman Brothers before it went bankrupt. And if you remember back in September, we did the Lehman Brothers anniversary stream where we actually broke down the events leading up to the great financial crisis. Oh, I did want to note before I forget. So at the conference that's going to start tomorrow, so the JP Morgan / Robinhood Investing Conference that is going to be tomorrow, we are going to have former Fed Chair Ben Bernanke speaking. Now, I am extremely intrigued, and I really wish I could attend that conference, because Fed Chair Ben Bernanke was Fed Chairman throughout the entire great financial crisis. And I am very curious to see what he has to say about the actions of the current Fed Chairman, which is Jerome Powell. So I don't think his keynote is tomorrow. I think his keynote is on October 12th. But Ben Bernanke was the 14th chairman of the Federal Reserve. And he resided in office from 2006, I believe. I think it was 2006 to 2014. Yeah, Carson says a new Nobel Peace Prize winner in economics. I know. So congrats and congratulations to Ben Bernanke on that huge accomplishment. Yeah, Western Mass Dave says Nobel Prize for Ben. You're right. Now that sparked some outcry. What do you guys think about that? Just curious. Now, I never want to take away from somebody's accomplishments because it's an amazing accomplishment. I honestly wish him the best. But there was many people that had a sour taste in their mouth. Blues writer. Hilarious. Wow, look at this restaurant. Very fancy, a lot of people in here. Mike C says Michael Burry's tweet about Ben's Nobel was funny. You know, I saw that, Mike C. Mike C and anybody else in the chat. Did you also see Michael Burry's tweet about Cathie Wood's ARK Innovation ETF? Did anybody see that? Now, there's a very notable chart, which I'm sure all of you have seen. It is the classic Wall Street market cycles chart. Does everybody know what I'm talking about? And if not, I want you to Google Wall Street psychology market cycle chart. And you'll see the classic chart that has a meteoric rise, and then it goes like this, and then it goes like that. And Michael Burry overlaid that chart, the classic chart that you learn in like Investing 101, with Cathie Wood ARK Innovation ETF. And it was quite literally the same thing. Now, not to pick on Cathie Wood, and again, I've said this at the beginning of the live stream, I think she is an absolutely brilliant woman. I think she's a huge pioneer on Wall Street, and she's extremely successful. And I think she deserves a lot of praise. But as we've been talking about ZIRP, or zero interest rate policy, it seems as if that investing strategy of investing into very, very high growth, high beta only works when interest rates are artificially suppressed for some time. It doesn't work in an environment of interest rates rising. Really quick, I wanted to show you guys, this is the Alliance Bernstein building. However, in this building is Fortress Investments. And speaking of Fortress Investments, Michael Novogratz is an alumni of Fortress. And I believe Michael Novogratz will also be speaking at the conference tomorrow. He will be leading up a keynote speech. I think he'll be obviously touching on cryptocurrencies, because Michael Novogratz started his career on Wall Street. I believe he worked at Goldman Sachs, then went over to Fortress, and then started his own venture, Galaxy Digital. And their goal is to onboard institutional clients to the cryptocurrency markets. Hey, Patricia Ivory says, I love New York City. My girlfriends and I watch you every night. Thank you so much for watching. I appreciate it. I hope you're enjoying the content. But if you guys enjoy what we talk about each night on the live streams from a financial analysis perspective, if you scan the QR code on the screen and punch in your email, you will be signed up to receive for free the Behind the Street newsletter, which is a free investing newsletter that I write for everybody, where I analyze not only the US equity market, but emerging markets, fixed income. We talk about real estate. So if you want to be up to date, scan the QR code, punch in your email, and you'll be signed up to receive it. But now we are walking past the Charles Schwab building. And we are going to be passing Neuberger Berman and UBS. And here's the flagship Hilton Hotel. Mimi says Nobel Prize to Bernanke equals almost a nice sarcasm. Yeah, I mean, many people were not happy about that, which I understand. And many people are just, I would say, not as happy about Fed Chairman Jerome Powell, the way he is handling monetary policy. But at the end of the day, I mean, look, we can't blame everything on Fed Chair Jerome Powell. It's not all his fault. You know, we do have a fiscal side of the house too, which has been running rampant, spending like crazy. Hey, David Perez is very entertaining. Thank you, David. Pup, thank you so much for being here. Dusty Cole, hope you had a good day, my friend. Deep Value Alex, Tom, can anybody watch the JP Morgan Robinhood conference? So here's what I think is gonna happen. It may be live streamed. And the answer is, I'm not sure, but they usually post some of the interviews after the fact, because I think we've talked about this before on the live stream, haven't we? And Deep Value Alex, I think I actually gave you guys a link to the interview of Paul Tudor Jones and Stanley Druckenmiller at the 2017 conference. So I would assume at the conclusion of the conference, this is the Neuberger Berman building, by the way. One of my favorite buildings here. At the conclusion of the conference, I think they're probably going to post some of those interviews. At least I hope. I'll read you guys a list of who's speaking there, but this is the UBS building as well. Hey, Emma is here. Says, hey, Tom. Hey, Emma. Good to see you. Oh my gosh, everybody. We have the one and only Dan Russell. Says, whoa, you can see the World Trade Center down the street. Yeah, you can. It's a really, really clear night here, Dan, so fantastic. Dan Russell, the man, the myth, the legend. Good to see you. Always a pleasure. So we'll talk about some of the people who are going to be speaking at the conference. And I'll do it in order of who I'm most excited for. Should we do that? I think that's okay to do that. Number one, Larry Fink, CEO of BlackRock. Very interested to see what he's going to have to say. Oh, actually, I already messed it up. I take that back. I am most interested to hear Ben Bernanke speak. And I'll tell you why. And I get it, yeah, he won the Nobel Prize. That's not the reason why. I really want to hear a former Fed chair's take on the potential future of monetary policy in the United States. And Ben Bernanke was the 14th chairman of the Federal Reserve, serving from 2006 to 2014, obviously served throughout the great financial crisis. So I think that's going to be really, really interesting to hear him speak at the conference. Number two is Larry Fink, the CEO of BlackRock. Number three is the owner of the New York Mets. I guess more notable, the founder of Third Point, of Point72 Asset Management, Steve Cohen. And then I would say Paul Tudor Jones, and then I would say Ken Griffin from Citadel Securities. Yeah, Mimi says he will support kicking the can down the road. Oh my, okay guys, I think this sets a record. Is this a record for the line on Adele's Famous? I think this may be a record tonight. Look at this. It goes all the way down. This is a 5-hour line, not even line. Dan Zhang says, Tom, I've been a Paul Tudor Jones fan for a long time, especially after watching the documentary on how he successfully shorted the market in 1987, aka Black Monday. Yeah, that was a good one. So, Dan, if I'm thinking of the right one, is that the one on YouTube and they have, it showed him at the ski resort? If that's the one, then I've watched it. If not, could you drop the link? I would love to watch it. Hey, Carl says good evening. What's up, Carl? Teresa Diaz. Fluttershy says, what's for dinner, Tom? You know, I'm not too sure. I didn't even eat dinner yet. I got to eat something. Yeah, Robert is like probably hungry waiting 5 hours for food. That's true. Del Frisco's good spot. Good joint. So the good news is as we get further down 6th Avenue, we're going to see an amazing view of the Empire State Building. Dan Zhang says, yeah, that's the one. He bought it back to the copyright. He didn't want his trading secrets to be revealed. Wow. I didn't know that. That's wild. Luciano says, what time do you usually eat? Well, I try to eat after work, but today was so busy for me that I literally worked all the way up until I had to stream, which was at about 8:30. So I never even left the office. So I'll get something before I get on the train. But I usually like to eat, I don't know, 7 o'clock, 7:30. right around there. Christian Wilson says, I just ate Whole Foods Hot Bar and it was great. Whole Foods owned by Amazon. Now, I think that was probably one of the best acquisitions Amazon has ever made. So this is 1211 Avenue of the Americas. This is outside of the News Corporation building. And obviously News Corporation owns Fox News, Wall Street Journal, Investors Business Daily, and Barron's. Hey, 918 says, hey, new subscriber here. What time is it there? Thank you for doing this. I love New York. I'm not too sure what time it is. Can we get a quick time check in the chat? I think if you type exclamation point time and then the city, it'll tell you the time, but I think it probably is like 10:30 now, isn't it? We're already over 2 hours on the stream. We've pretty much covered everything we needed to cover. Now, since today was Columbus Day, the bond market was closed. So tomorrow is going to be absolutely critical to keep our eye on the debt market, because I always say the stock market derives its value from the debt market. And I think we're going to continue to see some pressure here, some selling in the bond market. I think we're going to see that 10-year US Treasury crack 4% by tomorrow. Somebody says Amazon needs to acquire USPS. That's actually really funny. Ah, 1047. So we're on West 45th Street. We are passing the Marsh McLennan building. And now that we're on topic of finance, D.E. Shaw, the quantitative hedge fund, speaking of Amazon, that Jeff Bezos used to work at, is right in this building. D.E. Shaw. And I think, could anybody confirm this? Maybe Dan Zhang or somebody in the chat. I think Matt Turner, I forget his name, maybe Max, I think it's Max from D.E. Shaw, is also speaking at the conference tomorrow. Could anybody remind me what his name is? I think it's Max. Hey, Junior B from Williamsburg, Brooklyn, good to see you. David Perez says hello from the Bronx. You know, David, back in the day, I used to work right off of the Grand Concourse. That was back when I was doing some consulting with a pretty big home healthcare agency. I used to take the train up there. William, oh my God. William, I can't read your comment, but you gave me a good laugh. Ah, Max Stone. I think you're right, JR. Thank you for that. D.E. Shaw. All right, quick, now that we're coming up against the end of the live stream, let's get a quick rating in the chat. The Empire State Building. I'm gonna go 9.6. I'm gonna go 9.6. What about you guys? View of the Empire State Building in the chat. I'm gonna say 9.6. That's a solid score. 9.6, beautiful. Outside of the Bank of America Tower. 8.8, wow. It's in the 8s, not in the 9s? All right. Mike's is 8.5. Jim Wolf says it's a 10. There we go. All right, here's the 9s. We got the 9s cranking in. Patrick is at a 9.9. Yeah, I couldn't believe so many scores were in the 8s. Sandra Dickinson, good to see you. Hey, Sandra, happy Thanksgiving, by the way. Sandra's joining us from Canada, so good, happy Thanksgiving to all of our Canadians. David Perez. Patrick, New York, trust you're well. All right, team, I gotta put you down for a minute. I'm gonna take you with me to Penn Station, but I gotta get the battery. All right, we're good. We're passing Salesforce Tower, ticker symbol CRM. Yeah, Blues Riders is Rat Cam. Hopefully you guys didn't, hopefully no roaches were encroaching on the stream. I gotta pick up the pace, I gotta get the train. I'll give you guys one more shot of Bryant Park, overlooking the beautiful Steven Schwartzman building, as well as the One Vanderbilt building. All right, we gotta pick up the pace here, everybody, so I may not be able to read the live chats as much. But I'll take you guys with me to Penn Station. But thank you everybody for joining the stream tonight. I think we covered a lot. I think we got a lot done. I hope everybody had a good Thanksgiving. For all of our Canadians, good Columbus Day. And I hope everybody has a good Tuesday. I gotta run through the light. I gotta make the train. I can't miss this train. If I miss this train, I gotta wait an hour. Not gonna happen. Wendy England, Andrea Zay, Patrick New York, Michelle McGraw, all of our moderators, Tom G, Bagels and Walks, Mohammed, Cynthia Beal, Jim Wolf. Appreciate you, Jim. Ooh, we didn't make the light. Hey, East Coast, what's up, man? Good to see ya. Sunshine, New York City, Blues Rider says I should whistle more often. Marcy, thank you. Western Mass Dave. Michael. Yeah, I think we'll be all right. I think I'll just make the train. I don't think I've ever missed the train yet on the stream, so. NV. Old Blue Eyes is right. Now, we'll be live tomorrow. So we should be live tomorrow at 8:30 p.m. Eastern Time. I think it's going to be a very volatile day. Joe Driver. Mahmoud Yusuf, thank you so much. Wow, joining from Egypt.
Where you at?
Good to see all of our viewers from Egypt. That's awesome. Charlie Richardson, thank you for joining tonight, my friend. Can we get a quick time check in the chat? Just want to make sure I'm going to make it. I think I will, but... Wow, look at this. That's a cool mural right there. Wow, look at that. It's awesome. All right, 35th Street. We're going to take a little bit of a detour through the park. All right, we're going to go this way. Macy's 34th Street. Herald Square. Ooh, 10:59, my God. I think I'll still make it. I think we'll be good. Andreas is like, just take a Suburban to Long Island. Yeah, that would run me probably like $200. No way, no way. Sunshine after rain is almost there, Sass bro. Almost there. Look, I think it was a good stream. We got some road work in. Probably covered a lot about the inflation era, the volatility in the dollar in the 80s. The tech and telecom bust of the 2000s, or the 95s and the 2000s, leading us to the great financial crisis. And then the teens is ZERP, quantitative easing, QE 1, 2, 3, 4, infinity. Artificially suppressed rates, which has led to a lot of this speculative activity on Wall Street. And even the start of all of these SaaS companies that only focus on top line revenue growth. Well, that business model doesn't work. All right, almost there. You know, if I could find a way to stream the conference tomorrow, I will do that. right, team, I gotta run. Thank you everybody for joining. I think we had 900 people in the live chat tonight. I can't thank you guys enough. If you're new here, click the subscribe button. We'll be back tomorrow, 8:30. R2D2, Sabrina Fair, Wendy England, Ryan Royal, Joe Mohammed, Patrick New York, Abdullah, Sabrina Fair, Michelle McGraw, everybody. Have a great Tuesday. Get excited for the day ahead. And to the mighty bull, have a good night wherever you are, because there is always a bull market somewhere, and you just need to know where to look. If you want to connect with us on Twitter, you could follow @WalksWallStreet. But until then, I'll see you guys in the next one. Take it easy.